Welcome, everybody. Glad to have you all here. My name is Kenny. I'm here with my co-host, Nicole Furlong. And today we are doing a 101 on financial modeling. The goal here is really to help you guys provide the infrastructure and visibility to really get that roadmap to get a sense as to how to achieve profitable growth. So I'll be doing a quick presentation. So we'll do a quick intro about ourselves. That'll give you a sense as to kind of our backgrounds and where we're coming from. Would love to also just give you a quick sense as to the firm we're working with, Pilot. Pilot is the largest startup-focused accounting firm in the United States, and we do everything in relation to your back office on the financial side, from bookkeeping to tax, CFO services, which is where Nicole and I both sit, and we service thousands of startups from bootstrapped to venture-backed, from pre-revenue to hundreds of millions of dollars in ARR. And the way that this is even possible with our team is that we use a bunch of full-time US-based finance experts that sit in our office in Nashville, San Francisco, and New York. And we have a really talented R&D team that builds software around the processes and systems that we've been building. So that way we can have scalable systems to really help with creating, booking things in a reliable, accurate, and consistent way. In the consumer world, that is very relevant, especially when it comes to Shopify, PayPal, Amazon transactions. Being able to use technology to properly categorize a lot of those at scale, and for us to really be able to focus on the transactions that matter is, I think, one of the biggest value propositions that we do have. And with Pilot's technology forward approach to accounting, you can focus on what truly matters, which is building your brand. Now, Nicole would love for you to give your intro, and then I can do one myself.
Yeah, I'll kick it off. Hi, everyone. I'm Nicole. I'm leading the consumer and retail CFO services team here at Pilot. And my background is mainly in investment banking. I worked on M&A mainly for consumer and retail companies before this. And I also previously worked at an e-commerce company doing strategy and planning there. So I've been at Pilot for about a year and a half now, and excited to be here and for us to do some financial modeling together.
Great. Thanks, Nicole. And for myself, my name is Kenny. I've been with Pilot for 2 years as a fractional CFO across the consumer spectrum. Prior to my time at Pilot, I started off a couple years in investment banking as well, went to a consumer venture fund after that, where I was focused on everywhere in the consumer space, food and beverage, consumer retail, health and wellness, so on and so forth, helping with management teams with just very strategic finance needs. Spent a couple years after that at a cannabis brand where I was leading product development, supply chain, go to market, and really saw that connection. I think this is my favorite part, is really seeing that connection between what's going on the numbers and actually what it means to execute and do it. And then took that and really just joined Pilot and kind of synthesize all that together. So happy to be here and look forward to presenting it together. So now on to today's agenda. Today is really all about financial modeling basics, but it's not just really about just teaching what a financial model is. It's really more so how to use it, our philosophy behind it, and the ways of which it really ties into how to utilize it for your business in a tactical way. So first part is really going through what a financial model really is, kind of on a philosophical perspective. Give you a sense as to the way Pilot thinks about forecasting and financial modeling, to give you a sense as to how we may be employing it across our clients as well as potentially you guys. Some KPIs, go walk through on KPIs that we think are probably some of the most important things, especially in the CPG space. A walkthrough then on the forecasting methodologies that we tend to see and go through, just to give you a few ideas as to how it can be applied and why it would matter. And then last, we'll have a live model walkthrough with Nicole that will bring a lot of those concepts together and really just you can see how it gets applied on a practical basis. As we're going through this, please feel free to, if there's any cool ideas or questions that come to your mind, feel free to just throw that into the Q&A or chat. And, if we have the opportunity to do it live while it's relevant, we'll be happy to answer it. If not, at the very end, we'll be able to just take care of it through just a series of Q&A questions. Great. So financial modeling 101, what is it, right? What is the basics behind it? Personally, I think really what financial modeling is, it's scenario building. It's being able to use a spreadsheet to create a scenario in front of you as to what we think can happen. And so that way you have something of which to act upon and then compare as to how that, what actually happened and why is it different from what you forecast. Scenario building, I think at the end of the day, is one of the most important aspects of financial modeling. It's about telling your story, being able to lay it out numerically or in some form or another on a spreadsheet, and to be able to share the vision of the business so that everyone is on the same page and you have the same, and everyone's looking at the same drivers so that we all see how the logic makes sense. For a financial model, typically it uses the combination of past information and then that of which then informs into the future. But more importantly, it's really about the future and then using the past as like, areas of which, historical precedents to kind of use to inform yourself. And the purpose of a financial model really is to create a vision of the business, a sense of what is going on in the business, from a financial lens, from everything that you own to what you owe to what you make, and where the cash is flowing, and be able to see all that in one consolidated picture, and to know that if you move one thing, how does it interact with everything else, and how do we think the mechanics really work? And I think that's so great because you can really see kind of everything in one picture and how it all talks to each other. And with that, you can really then envision, if I am pulling this lever, what does my business then start to look like? And also as well, what does it mean to pull that lever? To me, it really helps just kind of bring it all together and then also translate something from numbers into something that's actionable. And you have the ability to test assumptions and really analyze, the potential impact of it. Personally, I use financial modeling for dancing. So just give you something that can give a sense as to like how scenario building works. I make, I break dance. And so sometimes I like to make combos. I'll name a bunch of moves, put in a spreadsheet, like link them up with each other, think it's a good idea, go test it out, realize it doesn't work, and then I might adjust it accordingly. So you can see kind of like how expansive scenario building can really be. And that's kind of the reason why I like it so much and why I love Excel. So what makes a good versus a bad model? I would argue, from our experience with clients, really user experience is probably one of the most important aspects of being able to, it is important to be able to outline as much as you can about how the business works. But more importantly, it's about seeing that bigger picture and being able to have something that you can audit against, that has clear and reasonable assumptions, and that you can follow through and everything makes sense. I think that's probably one of the most important attributes, and it's easy to get lost in the sauce with financial models, as I'm sure many of you have seen models with like 20 tabs and so on and so forth, which depending on the purpose may be good, but in our philosophy, I would say being able to capture things and be able to see it all is probably the most important aspect for us. And some examples of models that you'll typically see out in the wild are, I think fundamentally the operating model, which is where what most of you are probably going to be most curious about and using. It kind of shows the big picture sense of the business, from the way the cash moves, from what you owe and what you own, as well as the profitability of a business at a given period of time. We'll also have other examples like merger models, which kind of show the scenario of what happens when we put two businesses together. You also have a discounted cash flow model, which shows a theoretical sense of what the business should be worth today based on how much money it makes in the future. And then leverage buyouts models, which is a model on the financial scenario of buying a business and using debt to do so. So there's many other models, but these are typically the big four. And even the dance example I showed is also an example of like another model. So it can be pretty creative. Now, when it comes to Pilot's philosophy on forecasting and financial modeling, I like to use the analogy of a knight. So from the beginning, we like to develop infrastructure, the financial infrastructure that creates visibility for you then to develop actionable insights. And so going back to the analogy around a knight, the way I like to see it is the financial model really is the core body, the knight. It does everything. It can take all the actions. It's the bigger picture and really the basis of which you make a lot of your decisions. And then you have, the aspect of, okay, well, if I want to accomplish a certain objective, how do I keep myself accountable? How do I track that? And how do I make sure XYZ happens and that we're holding ourselves to what we said that we were going to do? That is the sword, and that is the KPI sheet. KPI sheet is then something that we like to develop for a lot of our clients that allow them to really stay accountable for what kind of objectives that they're trying to achieve based on what they see is necessary in their financial model to achieve a certain objective. And then there's the aspect of the shield, survivability. You have to be able to, manage your lifeblood, which is your cash. And that is where the cash flow model comes in. It's a really useful tool on a tactical basis to really understand how you can tactically move cash around so that way you can keep the business alive on a day-to-day basis. So with the core knight, you also have your sword, you have your shield, and then that creates, in our philosophy, kind of like the full toolkit that allows you to not only see how, to not only see your vision, but then to understand how it gets executed, as well as how you can survive to that point. So, going individually, financial models usually really great for kind of looking at the scenario analysis of your entire company. If you were to do XYZ, it's really good for strategic planning and getting all the teammates together to understand, okay, this is kind of how everyone's contributions come together and really create a business that can succeed. Kind of really feeds into that bigger picture aspect and really is great for that medium and long-term view. So that way everyone understands like how this all moves together. Now, the weakness on that is it's less effective on the day-to-day and on the tactical side of things. And it can often be a little bit too complex because it puts all these pieces together. And that's where the KPI sheet then comes in. It's really tactical, allows you to track things possibly on like a daily or weekly cadence. You can go into that level of detail that you really need for your teams to get aligned. And it helps with just building that accountability. And then on the cash flow model side, usually we like to build something that's weekly or biweekly, especially when it comes to important things such as vendor payments, needing to push certain things back. It gets very, very tactical. And you want a tool that specifically caters to that. And that's where the cash flow model really works well. And it's really good, really focused on kind of that short-term aspects of things. So that's kind of the Pilot philosophy on the three core tools. Now, with these different tools, even when we have something that's grasping your medium, short, and long term, it's still easy to get lost in the sauce. And I think that's kind of where KPIs, whether on all of these tools, really start to matter. Each of them are going to have different emphases and examples of which you're using as a North Star. So some examples of metrics that I wanted to share with you here as to what we think are particularly important. One of which is the cash conversion cycle. In my opinion, that's probably one of the most important metrics to really have a good grasp and understanding, and it does capsulate a lot. But essentially, it's that amount of time that it takes for your business to convert investments onto inventory to then the amount of monetization of it. And there's so many levers in there that we love talking with our clients about. It involves potentially manufacturing negotiations, payment terms with them, looking at alternative non-dilutive financing options, potentially also talking with the customer or the retailer, understanding their payment terms, how you can really push that forward. All this in our view is very important because for a scaling company, the longer your cash conversion cycle is, the more it's just trapped in your business and you can't really utilize it. And especially in a tight cash environment, this is probably one of the most important things to really hone in on and get right in order to scale your business without needing tons of capital upfront. Another KPI that we tend to love looking at is contribution margin. I think a lot of business, a lot of VCs and business owners tend to look at gross margin, which is also a really important metric. But I think in today's world, that view into contribution margin is really key. And that usually encapsulates really a lot of the basically revenue minus a series of variable costs, which include your cost of goods sold, shipping and fulfillment out directly to the customer, paid ads, anything that is, every time you sell a unit, you're going to have these associated costs. Merchant fees, there's another example of that. I think being able to track all those variable costs is absolutely critical, because you really do want to see how much money you're making from every sale beyond just like the cost of the good itself. And until you do the proper cost attribution on that, you could be flying blind as to why are you losing cash, even though your gross profit could be positive. So probably one of the more important things to also track as well. The third metric is returning customer percentage, which is just, in terms of the percentage of your pool of customers that are in a given month, how many of them are returning customers. I think there's pundits tend to say the right number, and it depends on industry, but it tends to roughly estimate to about 30 to 40%. I think every business is going to have something a little bit unique, but I think understanding your historical percentages and tracking that is really important, because there is a little bit of balance. You don't want that returning customer percentage to be too low, because it indicates that your customers are not coming back. But if it's too high, especially if you're trying to still scale your way into profitability, then it probably may be an indicator that you need to invest more into acquisition marketing, because you're leaving money on the table essentially. And then the next one actually is customer acquisition cost. That one's also incredibly really important to really understand all the elements that it takes into acquiring that customer, and especially in relation to the amount of value that brings in. So usually, we like looking at LTV CAC as a result of that, to really gauge an accurate sense as to the profitability of each customer. And then the last one is inventory days, which the average number of days that your company holds on inventory before selling it, I think is also one of the more important metrics. You have to be able to balance that against how you're purchasing. And I know there's always that big conundrum around, hey, if I can just hit this next volume break, then I can get lower pricing and my gross margins get better. But at the same time, you also have to be cognizant of the fact of how much capital are you tying up as a result of that. A lot of these metrics at the end of the day are very interrelated. A lot of times there's not one right answer, because one can be right and the other one can be way off. And so there's a little bit of a active management between all of them to make sure that they're at certain kind of bands. And this is where, this is kind of the exciting part of really being able to look across all these metrics. And this is one of my favorite exercises with my clients, is to understand, like, yes, you're really focused on this, but hey, we, take a step back. We also have to look at this other metric and make sure they're all balanced with each other, perfectly balanced, as all things should be. And a lot of this is tracked across our financial tools. So, the financial model, typically you'll see contribution margin in there. That's usually kind of the best means to track that. Usually for other metrics like AOV, returning customer percentages, a lot of times you tend to prefer to see that on a weekly KPI tracker. That kind of helps the management teams track that and see if certain campaigns or things that are kind of a lot more on a weekly tactical basis are kind of moving in line with what they expect. With 13-week cash flow forecast, it's a lot more or less likely about kind of things related to inventory. So you'll see more of those aspects tracked there. LTV CAC analysis is also a separate analysis that we do, and that really, then customer acquisition cost becomes really important for that. So in regards to forecasting methodologies, we have a wide range of methods that we use to forecast on the business. It really depends on the situation, as well as kind of what we believe is to be the driver. Here, I wanted to show you just 4 examples of which we will apply forecasting into a model to give you a sense as to those kind of different ways to think about it. First one is bottoms up, which is really just starting from a detailed build of what you're going to do and how that then builds up into sales. So an example would probably be, you have 4 SKUs, you're trying to sell into wholesale channel. You then make an assumption around, okay, I'm going to sell this many SKUs to this store, and then this many SKUs to this store over a time period. And you basically kind of build that up. And with that, you're able to really get a sense as to, okay, if I am able to accomplish XYZ actions and then kind of compound that over time, then I can start to get a sense as to how large the business can really get. Now, in contrast, there's then the top-down approach, which then really starts from kind of a vaguer, bigger picture, and then distills down as to where the revenue opportunity is. So an example would probably be, let's say someone's looking at the CBD beverage market. You then kind of start with the larger CBD market. You then kind of distill that down into like the subcategory, and then you kind of distill that down to certain geographies or number of retail accounts, and then you go from there to then understanding, okay, well, if we penetrate X, Y, maybe like 5% of that market, what does that represent? What is the, what would we assume would be the average AOV of every retail store? And then going from that approach down into what we think the revenue could be. The other method would then be historical analysis. That's probably one of the most popular ones that you'll tend to see. For seasonal apparel, that becomes really important. You'll need to, a lot of times what we like to do is create a seasonal adjuster for seasonal businesses. So, and over emphasis on fourth quarter or some of that sort, in order to really, take what we've seen in the past and really apply going forward, especially if we see a consistent pattern there. A lot of the times you also tend to use, prior year comparables as a way to inform what's going on in the future. And it's usually one of the most reliable sources of data to really pull off from, especially if there's a lack of other data available. And then the last one is pure benchmarking. This is especially useful if you're selling a good that may have, similar attributes across others. So an example would probably be if you're selling a good, but your unique advantage is really related to the packaging. Well, then you can use pure benchmarking as a way to understand, okay, if their movement, maybe you're using Nielsen IQ as a way to find those comparables, but you can look at competitor movement per store and then use that and extrapolate that to what your performance could be, to then create a basis on the performance of that SKU going forward. So that was kind of a quick walkthrough on financial modeling, different philosophies, as well as some of the methodologies. And now you can finally see that in action with Nicole.
Awesome. Thanks, Kenny. Yeah, so switching gears a bit, we're going to walk you through our pilot e-commerce startup budget template, which I think you'll all get a link to this so you can see it yourselves. And you'll see a lot of these forecasting techniques that Kenny was talking about in action. So I'm going to go ahead, share my screen so you can follow along while we're demoing this. Let me know if you're able to see this model okay. So before we really dive in here, we'll do just a quick tour of the tabs that we have in this template, starting on the cover page that you can see here, which really just has a few basic assumptions, things like the company name, things like the first month of data. We also do have a legend. So this is how you can understand what our color coding system is like. So you'll see a lot of these yellow boxes with blue text, like the one here, which is where we're going to be directly putting inputs into our model. So you'll see a lot of those as we start to go through the different tabs. And from this cover page, you can actually navigate directly to the other parts of the model. So it helps you get around quickly. So we're going to spend today the bulk of our time focused on really these first two inputs tabs. So you can click right into them. The first one, inputs P&L. This is where we're going to be making all of our individual assumptions about our revenue, about our expenses. We'll go through this in detail, but just to give you a quick peek at it first. There's also another inputs tab for headcount, which is where we're going to build out a quick hiring plan and make some assumptions about our employee compensation. If I go back to the cover, once you've got inputs in for your P&L, for your headcount, you're going to notice the revenue build and also the expense build will start to fill up as you make your assumptions. So for now, this model is really just full of zeros, lots of divs. There's not a lot in here. Once we start inputting it, this is going to quickly start coming to life. If I go back to the cover, once you finish out all of the inputs tabs, you've got all your data, your assumptions made, that's when you can start looking at some of the outputs. And we have some nicely formatted outputs that you can use. giving, a summary of your monthly P&L. We also have a KPI dashboard that has some nice annual summaries, nicely formatted, some charts you can use. So this is a really helpful resource. You've got some ready-made outputs that you can use right from this template. There's also an instructions tab, which has some good just general thoughts to keep in mind as you're building any model. So this is something that you might want to take a few minutes, just check out later. But let's dive in and we can go ahead and start actually building out a model here today. So like I said, this is a completely blank template, no numbers in it. And the idea is that we can fill this out from scratch and start to see the model come together. And, I'd love for this to be a little bit interactive if we can. So as I'm going through, I'll ask for suggestions, for assumptions. There's really no right or wrong answers here necessarily. So feel free to throw out any thoughts. And I think Kenny is going to help keep an eye on the chat. So feel free to chime in so you can have some direct input here. And we're going to start, like I said, the first inputs P&L tab, and we're just going to make our way down here, filling out assumptions in each of these yellow boxes. Starting with the first section is our revenue. And you'll notice one way at Pilot, we like to forecast revenue is breaking it out between new and repeat orders, because we know there is pretty different purchasing behaviors for new and repeat customers. Kind of a good example of what Kenny was talking about with more of a bottoms up forecast approach here. So we'll do new orders first. I'm going to try to keep the numbers pretty simple and round just to keep this easy. And I'll go ahead, make just a basic assumption that we'll have 1,000 orders in our first month. And just to give this a little bit of growth, I'm just going to steadily grow this 100 orders a month and take this all the way out. We've got a 3-year model from 2024 to 2026. In reality, you're gonna, look at seasonality and look at peers and make this a lot more sophisticated, but we'll keep it simple just for today's purposes. Next assumption we want to make for revenue is an average order value. So maybe if someone wants to give me an AOV, I'll take an assumption here and drop it in. We get any ideas in the chat? And again, no wrong answers. 35, that sounds like a great assumption. So let's assume our AOV is $35. And we also have just one basic assumption for units. It's kind of just based on how many units per order. I'm going to say 500. Maybe someone's buying 2 units in an order. Seems like a fair enough assumption. So this is all we need to do for our new customers. One other piece of revenue is going to be our repeat orders. Again, these are the stats Kenny was referencing around repeat rate, how many repeat orders compared to new orders. I'm going to say maybe it's 250. So it's more like 25%. And again, we'll just grow this by a small amount each month and extend that out. So now we've got repeat orders in here as well. AOV, I'll use the same AOV that we used for new. Arguably, maybe it's going to look different for repeat customers, but we'll keep this pretty simple. Same thing. I'm going to guess our repeat customers are maybe buying 2 units. So I'm just going to half that. Or sorry. Yeah, there we go. So those are really just a few very basic assumptions. I put these in kind of quickly, kept it simple. But if we check out our revenue build, which a few minutes ago was all zeros and all divs, just by putting in those couple numbers, now I've already got a pretty nice revenue build output. We see it sort of steadily increasing, and I can see how my revenue forecast is shaping up. I've got not only revenue, I've got units, got some AOV. I can see some of these metrics in here.
Michael had a interesting point that he made where maybe units should be double, right? So total units should be 2,000. If it was 2 units
Oh,
or
good call. Yes, thank you for mentioning that. I was going too quickly.
I love that community participation. Thank you, Michael.
Thank you for that. All right, we're making sure everyone's paying attention today. So now we've got, like I said, we've got our revenue build. Let's go back now to our P&L, and we're going to start just working our way through the expenses. Again, there's a lot of expense buckets. We'll start out with dilution. So kind of anything like discounts, returns, that's going to reduce your gross revenue down to net. Let's see. Someone want to give me an assumption for discounts? I guess how promotional do you think we want to be in this business? If not, I'll make a 15%. Yeah, so
Okay.
maybe we're offering some discounts, maybe new customers or something. Returns. Hopefully our returns are pretty low. Maybe I'll put 2%. So now we've got some dilution coming in here. Next piece we're going to forecast is around our COGS, our cost of goods sold. We have a couple components here. The first is just the product COGS, so how much it costs to produce each of our units. Who wants to give me a COGS number, and we'll drop this in. And maybe think about our order value. Hopefully our margins are pretty decent on these. Yeah, maybe $7, and we'll see what that looks like. You know, at the end, we'll kind of sanity check how some of these assumptions look and how realistic our margins, all of that. But for now, we'll play around with these. Merchant fees. Again, this is going to depend a lot. Maybe what kind of platform you're selling on. Maybe I'll just say 1% to keep it easy. So those are all of our COGS assumptions. And again, I can kind of go to the expense build, start to preview again, like how this is coming together. All of this is linked in the model, so you don't even have to do really any work here. It's already starting to come together. All right, I see where my discounts and returns, what that's coming out to. I see what my COGS are. So this section's already done. And now we can kind of keep working our way through the P&L. So let's flip back here. So we've got a section in our model for selling and marketing expenses. So this is what we use to come up with a contribution margin on our P&L. So I'm going to say shipping and fulfillment costs. Hopefully this is pretty low. Maybe I'll say something like $5 an order. We'll see. And then the other big assumption, and this is kind of an important one that Kenny also mentioned on one of his slides, customer acquisition cost to acquire customers. Anyone want to give me, maybe just call out a number for our customer acquisition cost? And I'll put this here. It's definitely a key assumption. Okay, $40. Okay, we'll see what that 40-70. We're bidding now. It's going up. Okay.
It's gonna be interesting.
Yeah, we'll see how this all looks on the P&L when it comes together. So now we can kind of move on to the next bucket. Now we're into all the different types of operating expenses that we have. Starting with one that's probably the biggest for a lot of our customers that we see is the employee related expenses. I'll just put in a basic assumption for kind of employee benefits, payroll taxes, all of that. We usually just put this in as a percentage, maybe 15%. And we'll get to actual employee payroll in a minute, but we'll start with this. You know, we've got a lot of expense buckets here, so we don't need to go through every single one of them. But just to give you an idea, we've got this kind of broken out. You maybe I'll put in some facilities costs if you're like renting an office or something like that. A lot of these I'm just flatlining just to kind of keep this quick and simple. Again, in reality, you're going to think these through if this is growing over time, if there's seasonality, if there's things that maybe come up a certain months of the year. We've got a G&A, just general administrative bucket that can sort of just be a catch-all for a lot of different costs. Maybe I'll put in some costs here, maybe $1,000 a month. I'm probably going to have some sort of software IT if this is an e-commerce company, right? So again, I'll put some money in here for this cost. Depending on my head count, maybe I've got some travel and entertainment costs that employees are incurring. Hopefully we keep these pretty low, but I'll just budget maybe $100 for each. It might depend on how big my staff is. We've got all different kinds of professional fees. So again, this is pretty detailed. So you can kind of like really drill down on where your cost buckets are. I'm going to maybe budget for accounting, for bookkeeping, and maybe just use the other line just for anything else that I'm not thinking of. Let's see. Brand marketing, this can also be a pretty important expense bucket. So just want to give this a little bit of attention, especially DTC businesses. I think we see this with a lot of our customers at Pilot. Can be a pretty important area of spend. So I am going to put in, some budget for things like advertising costs. Maybe I'm working with like an outsourced marketing contractor. So I'm going to put that in. Maybe just some other. So now I've got some brand marketing costs in here. And there are other lines if you want to think through your depreciation costs, if you have some like equipment and PP&E, and then any kind of other expenses. Again, we just have a bucket, so sort of a catch-all for anything else. Yeah, and like Kenny said, if you have specific questions about specific ones of these and ways to think through them, we can definitely give more of a deep dive. But again, just kind of going through this quickly so you can see how this all works. So this was really quick, but we already have some inputs for our P&L. We've got revenue, some expenses. So this tab is pretty much complete at this point. So we'll move on to the next part where we have our headcount build. So this, again, is probably going to be a pretty big expense bucket for a lot of companies where it includes your payroll. So to build out your hiring plan, there's basically these 4 columns in yellow that you're going to fill out for each employee that you have. Both current employees, and you can also include future hires that you want to factor in as you're growing. So for each person, you're going to put their name, which might just be a placeholder, their position, right, their title in the company. Hire date is important, especially for future employees, and then what their annual salary is. So yeah, we'll put in maybe just a couple people. Maybe we have like 2 co-founders, right? Like the CEO and COO. So I'll put them in first. They probably started earlier. They've been on board, and we'll give them each kind of a nice salary. So you'll notice once you start putting in some of these inputs, the monthly salary cost already starts to populate in here for these employees. Yeah, like magic. Let's see, we'll give a few more hires. Anyone want to suggest maybe some other good like early stage hires that you might have on board to put in our hiring plan? And maybe they're future hires. Maybe we're starting to add some more people beginning of this year. Yeah, these are good ideas.
I like fractional CFO and Pilot.
Yeah, let's do a fractional CFO. I like that.
Definitely marketing.
They're probably not too expensive also because they're outsourced, right? So maybe I'll put this low. What were some other good ones we had? I saw good ones in the chat. Yeah, maybe an operations person. That's a good role. We don't need names. We'll just keep it to the role. they're probably making a little bit more. And maybe we'll put one more person. What was it good?
Marketing. I think marketing's been
Marketing,
cited
yeah,
a
that's
lot.
a key one. Yeah, like maybe a marketing manager, this could be. And maybe we're also hiring them this month. We're like really growing. And they'll be similar salary. Okay, so now again, just a couple key inputs, and now we've already got estimated salaries going forward, and you'll see this. Yeah, so some of these were former hires. Now we've got some starting, so this will consistently kind of forecast out. Okay, so I think that's pretty good for now for our headcount build. So now if we go back to this expense build that we looked at before, again, now all of those zeros, all of those errors now have all kind of been filled out, and we've got a full expense build to go into our P&L here. You can kind of see what our total operating expenses based on that has added up to. We're about $40,000 a month, it looks like. We kept this constant. So right now it looks like it's a pretty big percentage of your revenue, but then it starts to level off as we're growing revenues, but we kept our expenses mostly constant on the OpEx side, at least. So this is our expense build. Let's flip back, just orient ourselves with the cover page. So again, we filled out inputs P&L, we filled out inputs headcount, we took a look at our revenue build and our expense build. So we've pretty much finished this entire inputs side of the template. And now let's check out some of our outputs and see what these look like when it all came together. So again, the first one is the budget tab. And what you're going to find here is basically a monthly P&L for each month of your forecast. And all these green numbers are kind of pulling in from other places in the model where we did our forecast. So like this gross revenue line, this is coming from the revenue build that we did with the new and repeat orders. Here's your discount and return assumptions come in here. The cost of goods sold. So actually, it looks like we have about 42% margin. So maybe those assumptions were actually pretty good. This is not too bad. We do have a lot of selling and marketing expenses. So our contribution margin is negative.
Any of the
I think
customer acquisition
mostly
costs is
based
gonna be
on
a problem.
Yeah, that was pretty hefty customer acquisition. So you can kind of see where this comes together. And in real life, this would be kind of an iterative process where now maybe you go back and you start to fine tune some of your assumptions based on what you're seeing in your budget. So that's why this is helpful. And yeah, you've got all your employee expenses. So employee expenses and then other operating expenses as well are all pulling in here. We see where this totals up. Tells us what our net operating income is, what our net income is, our margin. So you've got a whole monthly P&L already built out for you right here. And then the other output tab that we have here real quickly is the KPI dashboard. So this one I like because it takes that monthly, very detailed view and gives you a quick snapshot of your business, looking at what the forecast is for the next 3 years. And this is already made for you. And we also have some nice charts that you can use, kind of showing some of the key metrics. So things like revenue, which is nice up and to the right.
Yep.
See what our gross profit, what our margins look like based on this, and breakdown of your OpEx, your headcount. So it just lets you see the model in a bit of a more visual way. Yeah, this is nice. You can use it for reporting or also just to kind of get a better understanding of your forecast as you're building your model. So I know that was super quick, but hopefully that gives you a little bit of understanding of how this template works, and definitely hope you might play around with it a bit on your own time. And if you have any, specific questions or run into anything as you're trying to use the template, definitely feel free to reach out to us and we can help you think it through in a more detailed way.
Amazing. All right.
Yeah.
I see a long, nice backlog of questions already.
Lots of questions.
Yeah.
Yeah, I was just gonna say that was awesome. I might want to quote somebody from the chat that said, that this is badass. So
Love that.
yeah,
Oh,
I mean, the comments are really great. Thank you everyone for all that participation. That was great. All right, I'm gonna kick it off and answer some of these questions, or sorry, read out some of these questions. I know there was a few that were in the
yeah.
chat as well. Yeah, go ahead.
The first one I want to call out, because there's been
Sure.
asked a couple times, is a link to that financial model. First and foremost, it's free, and you can have a link right here. I'm going to post. So now you guys can have it all for yourselves to play around with as well.
Amazing. That's the template for Excel tool. Is that the question?
Yeah, some people were asking if they could have access to it, so just wanted to repost that.
Okay, awesome. One of the next questions is, how would you suggest building a forecast if you are a new company launching your first product? We do canned beverages for reference.
Right. I can take that. I would say what you'd want to, with a new company, you don't have precedence, right? But I think that's kind of where benchmarking will become really important. Startup CPG has a great partnership with Nielsen IQ, if I'm not mistaken. So that could be for example, a good place to find comparables to then use to extrapolate data as to how maybe your velocities may be running. I think this is also important why you may see bottoms up analysis may make a lot of sense when you're starting to really think about, we really want to think about the tactics of like, okay, if I'm going to go out there and literally approach XYZ retail stores, I close X amount and, I'm going to see my store count build gradually month to month, along with, what I may project may be how many they sell per month. Then with that together, as well as maybe using Nielsen IQ comparables to figure out what that movement may look like per store, you can then kind of extrapolate out, the forecasted sales over time. That could be one example. I mean, the other example that I've used for other clients too is also that top-down analysis if you want to go that approach. But I think for something as tactical as going to beverage and retail, I think the bottoms up may be a little bit more appropriate.
Great. Thank you. All right, next question is, how do you forecast if historical data may not be reliable since trends fluctuate erratically? We're in Web3.
I can
Yeah,
take
I
that.
can start.
Oh, go ahead.
Do you want
Go
to go
ahead.
ahead? Yeah, I mean, I think this is definitely a challenge that we see a lot if there's not great historical data. So, I mean, I think that's somewhere that maybe you look at, peer companies, you could look at sort of market, look at industry data, see if there's benchmarking that you can use. Maybe your historical data might fluctuate a lot, but maybe look for trends and seasonality, and try to smooth that out in your forecast. So just a couple starting points. But I guess, Kenny, do you have any other ideas on that one?
Yeah, I would say, it's probably going to be some kind of Frankenstein combination, right? Where, some historicals, it sounds like some historicals may be relevant here and then others may not be. So sometimes it may involve really just starting with a historical, using a historical to then see where the numbers end up. Some of them are going to be awfully wrong. And then needing to, this is kind of why it's so important for us to really have a conversation with the founder to understand like, okay, why are certain things aberrations? And how do we adjust for that accordingly? This is the tricky part of really being able to combine qualitative and quantitative information. And that's why a lot of times I usually like to add comments in my cells to just really add that extra level of context as to why it may be different from the methodology across these other months. I think this also emphasizes how, the top down also actually may be appropriate here where I think it really depends on the driver behind some of those assumptions. Sometimes your drivers may not necessarily be coming from your historicals and comparing against that. For an alternative way of forecasting orders could be looking at the funnel of impressions to conversions and click-through rate to then order conversions and then using that as a basis. So I think this is kind of where you really have to think about the philosophy of what is driving your customer growth and then using that as the basis for your assumptions.
Okay, thank you. Next question is, for brands selling primarily in retail, what's the best way to track repeat customer rate?
Yeah, I mean, that's a good question. I think the repeat customer rate is definitely more relevant to kind of an e-commerce setting where you can track your customers, track those touch points, and really see if they're returning customers. In a retail setting, you don't necessarily have that data on everyone kind of coming through your front door and making a transaction. I think some companies are trying to, do a better job at collecting that customer data and try to record those touch points, but it's not perfect. And I don't know if all the technology is there yet to do it in a super accurate way, unfortunately.
Yeah, I mean, that's why retailers hold the power, right? They sometimes just keep that data. One alternative way that I've used in the past is actually looking at the individual retail stores as if they were the end customer, and then assuming that, assuming repeat rates with them rather than necessarily the very end customer, just because of the lack of data available, and you using just basically like the next available sense of visibility and working off of that.
Yeah. And in like a brick and mortar retail setting, you might have slightly different assumptions than the one we showed you here. So it might be more of a forecast based on sales per square foot and size of your store, and that sort of thing. So it might be a slightly different approach, not exactly the same as this like repeat rate driven forecast.
Okay, next question is, for new orders, should we not start with some form of marketing spend that drives new business / customers?
That is a good point, and that I believe is really going to depend. I mean, that certainly is the case. Like there are some clients where I absolutely use marketing spend with the assumption around customer acquisition costs to then forecast the number of orders are going forward. It really depends on I find the founder and their mentality as to what is their priority. Sometimes it's really looking at the vision of I want to grow this business and then figure out how much cash I need versus, hey, I have this much cash and I know where my customer acquisition cost is and how much money can I make, right? So that I think is more of a philosophical conversation as to what you're really trying to prioritizing and what your end goal is, and then adjusting how the model is driven based on how you're thinking about it.
Okay, thank you. Okay, next question is, how do you factor in the rise in COGS over time?
I think that's
So I guess I can start this one. I mean, I guess like mechanically in this model, right? You can change your assumptions from month to month, right? We were doing this pretty quickly and just kind of kept it flatline the whole forecast. Probably not the most realistic. So you definitely can adjust it over time and use different assumptions. I think normally you'd probably hope that your COGS might be declining over time. Maybe you're getting some cost savings there, but you can definitely kind of fluctuate that and a lot of the other assumptions as well over time in the forecast.
Yeah, that can likely also, especially if you're an inventory business, the dynamics around volume-based purchases and all that may involve a little bit more of a complex modeling scenario. So, Nicole and I have extensive experience with that, and that kind of involves kind of that three statement. That's kind of where the three statement model becomes so important, because you have to factor in the idea that the impact of inventory, and if you're in, if you have different unit costs that you might want to factor in that in the inventory balance, that rising cost, and then your average inventory value per unit goes up, and that feeds into your COGS. There's a little bit more of a feedback loop, and a little bit more of a dynamic modeling exercise. That was a little bit too complicated for this for this presentation, but it's something to keep in mind as to how we may factor in rising costs.
Okay, thank you. Next question is, does this connect to a balance sheet / CF statement? As we are seeing contribution margin is negative, you will also need to invest in inventory, so CF is going to be worse.
Yeah, so I can answer that. So yeah, this template really is just meant to build out your P&L. So it's not a full-blown three-statement financial model with a balance sheet and a cash flow. But we definitely do typically build models like that for our customers all the time. And that's definitely a good point. And I think especially for consumer retail, that the inventory part of your model is a super important area. And we do spend a lot of time on those assumptions. So this is just a simple P&L, but definitely something you would want to build out for your business.
Thanks, Nicole. Okay, well, what is the best way to get a true calculation of product COGS, cost per unit, if you have multiple SKUs? Would it be a blended average of all products?
Yeah, I definitely, for real businesses I'm working with that have multiple SKUs, I usually do set up for each one of the SKUs what the price is and the COGS, and do sort of a blended average of that. If you're using kind of a simple model like this, you might just take kind of an average product COGS just as a basic assumption. But over time, to be a little more sophisticated, you probably would want to break it out and do kind of a SKU level analysis and get more detailed on that. So that's a good point.
One tip on getting good COGS across your different SKUs, really good controllership. If you have a good controller on board, they can create the proper processes to absorb those invoices, understand how to allocate the costs, and give you a good sense as to where your costs are landing. And that provides an enormous benefit for people who are managing your forecasts to then you extrapolate that going forward. Especially if your COGS are varying quite significantly across different SKUs.
Thanks, Kenny. Okay, next question. Where would you put notes for things that affect sales, both negatively and positively, like out of stocks or specific marketing initiative?
Yeah, I guess I could start that one. Yeah, so like I was saying, when you're doing that kind of sale forecast or number of orders forecast, you probably would want to adjust that month by month, especially if you know you've got a big marketing campaign around the holidays, or if you know there's going to be some sort of shortage, like inventory shortage. So I mean, in a model like this, using a lot of like sell comments, side notes, things like that are definitely helpful as just like a modeling best practice. So you've got all of that recorded. And those are definitely the kinds of month by month variations you'd want to account for when you're making those revenue assumptions in the model.
Adding comments also tends to be really helpful for that, so that we can add that small element of context in there. I think this is kind of where user experience matters a lot. You'll really want to understand, like, not just you, but like the other users of the model. How do they best absorb information? Is it better to have a note document on the side with logs on changes that were made, or is it better to just have it in the model directly? I think that's honestly a big part of the conversation as to how to make sure everything talks to each other. You don't want, comments to be left in there and then suddenly everything changes and no one knows the right procedure on, how to update those assumptions.
Great. This is a good ending question, I think, but of course, we're at time, but we'll certainly hang out for a couple more minutes if anybody else has questions. It looks like there's still 98 people here, so I'm guessing there could be more questions. But what is the biggest mistake you see early stage founders under budget for or don't factor in pre-launch?
I'll say mine, or do you want to go
Yeah.
first? It might be the same.
You can go first, Nicole.
I mean, I think marketing expenses tend to be a lot bigger than a lot of people maybe account for in the beginning, and it's important because that's helping to drive your sales and get your name out, especially if you're an early stage company. But those kind of brand marketing and kind of paid acquisition costs can really add up, especially early on. So it's sort of a big investment in the beginning.
Nice. Mine would be overestimating how fast revenue starts to contribute into your bottom line. I think one of the biggest challenges that I've tend to see, especially when they start hitting like month 9 to 12 in their forecast period, is they make, a key part of the assumption is, hey, when you're generating revenue, cash eventually comes back into the business and that extends your runway, right? That is a big contribution to, the lifeblood of your business. And when you start missing those targets, that stuff starts just snowballing, and then you start realizing that your cash runway is actually a lot shorter than you expect, which is why, as you start getting, when you start thinking outside the box, like scenario planning in different bull and bear cases becomes so important. And that's one of the major things that Nicole and I tend to do a lot with our clients.
There's a couple more questions in the chat. Do we want to dive in? We have a 6:04. We can address them afterwards. Totally up to you.
You got time, Nicole?
Yeah, we can stay on for a few minutes. Yeah, we can also share our contact information too. So if anyone wants to have a longer conversation around any of these, you can also feel free to get in touch with us too.
Want to do 3 more?
Yep.
That's
Yeah,
a
let's do a couple.
good number to end on. Okay. So beyond the Excel spreadsheet that I currently use, are there systems that focus on COG from ingredients, recipe to packaging costs?
Yes. And this is to your point, it gets very complicated, right? When you're now dealing with raw materials, work in progress, finished goods, different input costs, like this can, on an Excel spreadsheet, can be kind of dire. And a lot of solutions that tend to come up that are relevant here would probably be something along the lines of like a Sin7, the Deer inventory system. You'll want to really, my tip on this is you'll want to really understand the flow of goods, the way you're tracking these invoices, the procedures of how you're managing all this, and be able to document in a way so that when you go up to these inventory management software providers, they can provide a comprehensive response as to what they can fulfill and not.
Second question here. What's the best way to model different sales channels, or should we use an average across channels for this model?
Yeah, so usually in our models, when we're working with customers that do have different channels, maybe there is a DTC channel, kind of like the e-commerce one we were talking about here. Maybe they also sell through wholesale. Maybe they also have retail stores. We do kind of model those out separately and have each of the channels with their own set of assumptions, kind of done in a really detailed way, and then aggregate that to see the total. So probably don't want to just use a simple average, just because there are pretty specific assumptions for those different channels, and you'll see customers behaving differently and different cost profiles. So you probably want to use a little bit more complex of a model for a company like that.
Yeah, a good contrast would be direct to consumer versus retail, right? There is
Yeah.
no necessarily direct ad costs associated with direct to consumer, but there may be things related to slotting fees, promotional programs you're working with them on. So, and you'll want to see the profitability by each channel as well. That's one of the things that we'd like to do a lot is create like individual, almost like sales channel pillars that go from revenue contribution margin. So that way, I think that helps a lot with investigating as to, where your money's really being made from.
Okay, last question. Besides the question that somebody wants to see the breakdancing move.
That's a good
Just kidding.
ending.
Okay, this is regarding the discounts as a percentage of revenue. How would you calculate the variability if you gave more discounts to certain customers on certain months? Would you aim to calculate a blended rate towards the end of the month? It's a two-parter.
I mean, you definitely could kind of forecast the discounts separately for new and repeat customers. I think that might be what the question's getting at. Maybe there's like loyalty discounts for repeat and new customers. So maybe you would want to do those separately based on different customer types. But if you wanted it to just be more simplified, kind of take an average, do a blended rate, you can. Probably more likely it would fluctuate month to month though, right? You see a lot of retail businesses maybe with more promotions during holiday, like Black Friday. So you'd probably factor in the seasonality of the discounts and then maybe drill down on new and repeat customers for that point.
Excellent. And anything else that you want to add before we wrap up?
Not for me, but yeah, definitely feel free. We left our contact information in the chat. So feel free to email us. Always love to talk through this kind of stuff with people, and hope you try out this model template and let us know what you thought of it.
Thank you so much. This was amazing. This webinar will also live on our website under resources. So it will be sent out to everyone as well. So no worries there. But thank you, Kenny and Nicole.
Yep, we had a blast.
Thank you.
Thanks for your time.
Have a good rest of the day.
All right, take care.
Bye.
Bye.
Bye.